Good afternoon, everybody. This is Jeffrey Halley from OANDA here in Singapore, and this is the weekly precious metals and commodity overview. We're going to go and take a look now through the precious metals, energy, hard and soft commodity setup, and have a think about what's been going on in the markets. And I think the most important thing that we've seen over the last 24 hours, if we look at this chart, it's showing the US 5-year T-note, and we've seen the US dollar generally go stronger, and gold, silver, platinum both fall off quite strongly. And part of the reason is, if we look at the bottom right-hand side of the chart, that the Stanford economist John Taylor of the Taylor Rule fame has now become one of the front runners to become the next Fed chairman after Janet Yellen. He is very much of a hawk, and his Taylor Rule actually says that rates in the United States should be at 3.5%, not the sort of 1.75% they are now. This saw a bit of a rush for the door in the bond market, and we can see here the futures have fallen, and this implies that yields are going up. So when the prices go down in interest rate terms, yields are going up. And this undermined the gold and particularly silver overnight. So worthwhile keeping an eye on this. It'll be interesting to see if we see some continuation in this, as the Fed has still been saying that they are getting ready for a December rate hike, and everything is still on track, despite some sort of contradictory data that's been coming out of the United States this week and late last week. Interesting to see if we get down through this 117.40 level, we have the potential to extend all the way down to this sort of 117 region, and that would be the highest that the US 5-year yields have been in 2017. Let's go straight to gold then and see what the effect has been. And we can see here, if I just blow the chart up, after a particularly good 7 days, from the previous week, we ran into a brick wall last night, and we saw gold fall from around 1306 all the way down to sort of the 1290 region before finishing around 1295, making a bit of a comeback. The market hasn't liked it today either, as we see gold has indeed fallen in Asia, trading from around that 1295 to just below 1290 before stabilizing around this 1290.5 area. Interesting for gold is that we did manage to hold, if we look at the bottom of here, the green bar, we did manage to hold around that 61.8% retracement area on the Fibonacci's, and we didn't really seriously test the 200-day moving average, although we did break the 100-day moving average. I think now for gold, it needs to really hold this sort of 50% retracement zone at 1281, with the next level, of course, being this 1263, 61.8. But it does show just what a huge beta that gold has at the moment to US interest rates and the effect that it can have on them. Clearly, next resistance is around the highs of yesterday, which is sort of 1306.30, and then around 1314.5-ish before we can start really thinking about gold perhaps retesting back towards that 1360 level. But certainly at the moment, everything is being driven by interest rates in the United States, and certainly not by any geopolitical events, of which we've had a few this week. Let's zip over to silver, and we can see the effect here as well. Again, it fell from 17.47 all the way down to around about 17.10, and again today it's fallen further and settling just below that 17.15 level. Silver had a much more constructive technical picture with the Fibonacci's. If we go down to this red line here, it's quite near to this 50% retracement area, which is around this sort of 16.575 region. It held this area beautifully. We can see here that the daily closes are all straight through this Fibonacci 50% retracement, and also it formed a pretty much a triple bottom here at 16.5377. This spike we saw from last week actually did break that level, but as we can see, it closed all the way back up at its highs. So this area still remains valid from a technical perspective. We've followed gold higher over the week, broken back up through the 100 and the 200-day moving averages, and we just seem to be doing some work here around the 200-day moving average. I think for silver to remain constructive, it needs to most certainly hold this sort of 16.57, 50%, 16.5377 region. So we could call that sort of 53, 57. 16.53, 16.57 is a must-hold area now for silver in order to maintain an upward bias in the metal itself. If we go over to platinum, certainly not been everybody's favourite precious metal this year, and of course it suffers even more when some negative inputs come out, in this case higher US Treasury yields. And we see here that it's failed now at the 100-day moving average, this red line, and this was a previous resistance zone around the 946 area. Let's just adjust this line slightly. It's interesting that it's actually topped out at this 100-day moving average. I think that's quite significant. It's closed there and gone straight down. We've fallen some, that's about 946 all the way down to around the 927, some nearly $20. And again today, it seems to be doing some work. We have a double bottom here at 927.60, and it just seems to be testing this. A break of this level would open a further fall down to this 903.85 area. It does seem a lot more vulnerable than the other precious metals to bad news at the moment. Clearly, this region now, 946.5-ish, is where the 100-day moving averages is the key level that it needs to break out of to the top side, with the 200-day moving average behind that at 957. Of course, it's not the same in palladium, the metal that keeps on giving. It's up 49% this year, and we did actually crack $1,000 an ounce overnight. I was reading somewhere that that was the highest that it had traded in something like over 20 years. Don't quote me on that one. But we can see that again when the US yields started moving after the stories that John Taylor may become had the front running to become the next Fed governor. It fell as well, giving up some of its gains. We do have a double bottom, which I can draw for you here now on the chart at 971.50-ish. So this is the key level for palladium initially. A break of this opens back down to the sort of level of congestion here around the 947.27.30-ish level. It's interesting that when it broke up through there, it actually raced to the top side. So this thick red line is clearly a pivot level in palladium at the moment. And then we come down to this 906.80 area, which is fairly close to this red line, the 100-day moving average, which is actually almost at 900 today. If we squish the chart up, though, and just have a look at it from perhaps a longer-term point of view here, we can see that we are still a long way from this ascending green line, which is the long-term support line. It hasn't really tested this seriously in the last 4 or 5 months, but when it has tested it, it's held beautifully. It doesn't get much better than this from a technical perspective. Hard to get bearish on palladium, with China data doing so well over the weekend, world growth, huge demand from the automotive sector. It's hard to see that palladium can really be looked at from a bearish point of view until we actually see some daily closes below this this long-term trend line, and also this blue line, the 200-day moving average at 840. So from my perspective, this chart still does look quite bullish, and it just seems to be the precious metal that keeps on giving. Copper too had a very interesting few days trading. We can see here massive breakout in copper. Let's just blow this thing up. We can see this double top here, which I will draw on the chart for you, around 315. when it broke through there. Clearly some stop loss action went through there once this double top from early September broke. Again, China lending data was very, very good. CPI was strong, and that's driven demand on the Chinese futures exchanges for copper ore, and this has flowed through to the US futures on which the CFD contract is based. And we can see here that we've exploded through this level at 315, and really, although it has come back slightly, the pullback itself is actually fairly marginal. This is clearly going to be a pivot line now, this 315, and it's no reason to really look at it as being anything other than bullish unless this line goes. This thick red line at the top here, which I need to squash the charts up to show you in its full glory. Now you can see why I had the chart expanded before. This is at 3.30, and that is a series of tops that go all the way back to sort of the mid-2014. This is the next target. A break of this level would set us up for a move back up to the 346.30 area, which is the highs in, let's have a look at that. Gosh, that's going a long way back. December in 2013. So certainly it does look like copper, as with palladium, has turned the corner, and we're seeing some serious underlying and fundamental demand for it. In the short term, though, this 315 area will be the pivot level. A break of that could see some fresh longs bailing out and a run back down to the 297 region. If I look at the commitment of traders report for gold and silver, which I have in front of me, the changes in positions over last week were actually very, very small. And the speculative market remains quite long gold and silver, but clearly because of those changes or lack of changes, and also in copper as well, I can see that we're pretty much at 75% of the year's highs in spec longs. Traders are generally quite happy to maintain long positions at this stage. Let's get over to natural gas. Just expand this chart out. Really not a lot to talk about here. We are still stuck in this large range, this long-term range, 275, 50-ish, 310, apart from this, which I would interpret as a false breakout into the top side. I think, again, you just have to accept that we are in a range, and you can make good money out of range trading. There's nothing wrong with that. You just need a little patience. There is nothing on this chart that suggests to me that natural gas is going to break out of either the upside or the downside anytime soon. So for now, we are solidly still in a range trading market. Not much to see there. We'll pop straight over to oil, where things have been quite a lot more interesting this week. Oil's had a good couple of days. It shrugged off higher rates in the US, and it's been driven by geopolitical worries. Some of you will probably realize that the Kurdish, Iraqi Kurdistan had a referendum a few weeks ago, overwhelmingly voted for independence. They want to set up their own country. This has upset the Iraqis, of course, but also the Iranians and the Turks for various reasons, but most of it being that none of them really want to see their Kurdish populations forming an independent state in the center of those three countries. I won't even get into the complications of that one. It makes my head sore. But what we saw yesterday was the Iraqi army going up to Kirkuk. I hope I've pronounced that correctly, which is a major oil-producing center for Iraqi Kurdistan. The general area produces about 350,000 barrels of oil from the pipeline complex there, but overall, there is about 550,000 barrels of oil a day that are directly related to Iraqi Kurdistan, of which they get most of the revenues for that. The Iraqi army entered and took over Kirkuk and the military airfield and the refinery / pumping complex. It sounds like without a shot being fired, but there does seem to be a fairly fluid situation there now as to whether hostilities will break out. This has obviously got traders nervous because that is potentially 550,000 barrels of oil a day that is going to be possibly taken out of the global market. And we've seen Brent march higher here. We were up yesterday in early Asia. When I was sitting here, we were up 1%, and it's actually held on to those gains. Looking at the long-term chart here, the long-term support line, which looks very similar to the Palladium one, it still hasn't been tested even with these pullbacks. So, and that line today comes in around the sort of 54.70 region. And so it's really hard to get bearish on Brent crude with the futures and backwardation as well. Until this line is broken and we see some daily closes below it. I think if we just draw another line on here around this level here, which is around 55 exactly, that support. We also have support around this 56.80 region. As far as resistance goes, we are sitting 59.10-ish is the line in the sand here. We really can't start talking about an attack on $60 a barrel, that magical Nirvana that so many of these oil producers are looking for from Brent this year, until we see some daily closes above this line. A spike above it won't do it. It needs to have a daily close. The initial interim support is around 58.50, 59, and then the psychological support will be, resistance, pardon me, will be that magical 60 area. Having said that, with the situation in Iraq, with the Kurds, clouding an ever more cloudy political situation in that region of the world, that should ensure that Brent and to a certain extent WTI remain well supported through the start of this week, even through the crude inventory numbers from the American Petroleum Institute tonight and from the Department of Energy tomorrow. Let's look at WTI. Coattailing Brent higher. And again, quite a constructive looking chart, to be honest. Support is clearly around this 49.99. Let's call it $50 a barrel. It'll be psychological, but it's also technical. We have the 200-day moving average behind that at around 49, along with support around 48.85. So there is some wood to chop on the downside support-wise for WTI. Constructively, though, it does look like it's getting ready to test this key 52.50 region that I've drawn on the chart. And assuming that there's no horror stories out of the crude inventory numbers tonight and tomorrow, it would not be unreasonable to expect that we could see a test of those of that level. This rectangular box I've drawn up here is the long-term resistance. It's the region where WTI post the OPEC trade, the production cut deal, yada, 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 and the extension of it. This is the region where it topped out. And this region sits between 53.5 and 54.5. So this long-term region is what really needs to break on WTI in order to start getting bullish on WTI from a long-term structural point of view. Remember, the futures there are still not in backwardation either. This is also the region where shale oil basically hedged by selling oil futures every time it popped up here. You could also say around this region as well, around each side of 53. And eventually that production related hedging, selling, caused the WTI bullish rally to run out of steam in a pretty brutal way, to be honest. But right now it does look like we are getting set for another test of that region. Let's move on to the softs. Pretty quiet this week, except for one, and I'm going to show you that in a minute. But it's not this one. The general bullish trends in the world economy at the moment, sort of rising interest rates have been ignored, but we're seeing stocks at record highs. We're seeing huge demand for industrial metals, to a certain extent precious metals, oil's on the move, etc., etc. Data coming out of the world in general, growth-wise, seems to be pretty solid. We do have the Chinese Communist Party's People's Congress. That's a heck of a mouthful. That's starting tomorrow and it goes for 3 days. And we are expecting a keynote speech from President Xi at the end of the week. Excuse me. Where he may actually announce some structural changes to the Chinese economy. We'll have to see how that one plays out. And no doubt we can talk about that next week. But in the meantime, all this bullish growth story around the world market seems to have passed quite a few of these grains and agricultural commodities by. And sugar is definitely no different there. We haven't really seen much movement on the commitment of traders report on the grains from last week either. So that meant that really traders are fairly nonchalant. They neither added nor subtracted much from their excuse me underlying positions. They are still net short sugar in the futures market, and that would probably explain why every time it gets up to this 100-day moving average, we seem to be failing against it. Right now, though, it does actually seem that it's getting ready to test this average and have a proper attack on it, and maybe stretch out to this 0.145 region a pound here. Key region, of course, is this 0.15, and it's really hard to sort of see sugar breaking out of its, or to call the end of the range of the last 6 months, unless we see this level crack. But definitely the 100-day moving average is a pivot level, and that's where speculators are adding to short positions when it drifts to that point. Key level on the downside, of course, continues to be this 0.125 or 12.5, depending on how you want to pronounce it. Pop over to the soybeans. This one's really interesting, though. I called this last week, and I do love it when a plan comes together. In this case, I've been calling for the last few weeks for soybeans to break out. In this perfectly symmetrical triangle, I couldn't actually tell you which way it was going to break out, but it was definitely going to break out. And finally, we saw that. We saw soybeans race higher by sort of 2.5% in one day. And they've actually managed to maintain that level. The driver of this was the US Department of Agriculture downgrading the 2017 total US crop of soybeans, having downgraded the 2016 crop a couple of weeks before. This saw shorts on the futures market scrambling to cover shorts, and up we've gone. And we seem to be fairly constructively consolidating at these levels as well after the initial rush higher. But certainly now, from a technical point of view, and it's perhaps a bit too soon to get too excited about that, it should really move. If you can see where I've moved the cursor now, 10.25 down to around about this sort of like 890, 630 region. So that would be about probably about $2. Sorry. So the technical target for soybeans should be around the $11.70, $12 mark. It's probably a little bit too soon to get too excited about that just yet, but certainly it has broken out and it's worthwhile keeping an eye on. First region I would be looking at for resistance, if I drive that, if I draw this on, would be this previous high in mid-July, followed by this high from earlier in July. So that's 10.1 and 10.265 respectively. It would be invalidated if we moved back down through this triangle and broke the 100-day moving average. Let's go to corn now. So not everything always works out perfectly, and I was quite excited about the symmetrical triangle. I have actually left it on the page today just to show you that sometimes these things don't work. In fact, probably quite often they don't work, but it hasn't actually collapsed. It hasn't actually really raced away. It has broken out of this symmetrical triangle, but then continued to sideways trade due to no real driving factors. And I think actually the agriculturals are in fact just looking at the total open interests on the agricultural futures on the commitment of traders report, with the exception of feeder cattle. Most of the grains and softs are sort of sitting at about between sort of like 40 and 60% of their total open positions for the year, which sort of shows you that traders are neither strongly pointing one way or the other. I think this picture now gives a more realistic position of where the corn market is. And yet again, we are in a range trading situation, and it's hard to get excited now about corn unless we break this top at 347.50 or move down through this longer term low around the 329.50 region. Let's wrap it up. Let's go to wheat. More of the same, I'm afraid, as far as the commodities go, with the exception of soybeans. With no real drivers, new drivers here in wheat. We've seen that when we moved down through the blue line, the 200-day moving average, it had been acting as a trading, intraday trading pivot. We've now had 4 days where it attempted to regain that average, but it failed. So it would most likely imply that if we were to break it now, that it would test towards the top end of this range, this 439.90, which is also very, very close to the 100-day moving average at 441. And I do like it when various levels all come together. But I think until that happens, we will have interim support at this double bottom. Let me just draw this on for you, around 4.1. So at 4.1, we have interim support, this double bottom here, and then the longer term support line at 393.70. And I don't think that we're going to see much action on wheat now unless we see either the 439 or 393 level broken. But certainly this bottom here in the middle of the range around 4.1 does look like an interesting support line. And perhaps the real range now is going to be sort of the 4.1 to 4.3 area. Okay, well, that's it for me for this week. I hope you found that enjoyable. Please do leave some feedback for me so that I can optimize these and make your experience better. Otherwise, I wish you a profitable and happy week of trading. Thanks very much for tuning in. Cheers.